Hello everyone, you're welcome back to my YouTube channel, and this is Forex Trading Made Easy. Okay, today we are going to be discussing risk management. But before we do that, we've touched on several areas. We've touched on indicators, we've touched trading strategies. So you have learned how prices move, you know what a trend is. You can actually execute trades, buy, sell on the MetaTrader 4 or MetaTrader 5 by simply going to the new order, placing a buy or a sell after setting your volume. You know what your volume is and all of that. Now, this is the most important part of trading, risk management. Now, risk management from the trader's point of view is important, and it is the major reason why a lot of traders they lose money in thousands and millions. Okay, so I want you to pay rapt attention to this course, as it is going to be a lot of insight. Even if you are an existing trader, this course will help you understand a lot that goes on in the market. Now, do you fall into the category of people that when you place a trade, you are not sure? Of course, there is that probability word. That is why we select our words to say probability, high probability strategy. So when you're creating a strategy, it is a high probability strategy that you're looking at. So the word probability means it is probable, it is possible to go either way, but you want something that works more, wins more than you lose. And don't be in a hurry to say, I found the holy grail that never loses, because that may not happen. Keep that in mind and choose your entries, exit volumes properly. So remember, we talked about trading strategies. You buy, you sell, make sure you have an exit. Exit is in two ways: when you are right and when you are wrong. So you can see here I have a trade entry and I'm expecting price to go all the way down there, and I have taken the position. Now, what informs my decision to take a buy or a sell depending on the lot size? What informs my lot size decision? Now, we are going to do a little mathematics. We need to understand certain terminologies: leverage. We need to understand what margin is, and then we already know what volume is, which we also call lot size. Okay, so we already know this. Now let's start with leverage. When you create your trading account, they give you different leverage levels. Some may give you 1 to 500 as the case may be. But something happened a few years ago, and some regulatory bodies, especially the US and the European Union, they no longer allow, some countries don't allow leverage more than 1:50 and 1:30. Now, what does this even mean when they say 1:50? For 1:50 simply means with $1 you would be able to control $50, literally speaking. 1:100, it means for $1 you will be able to control $100. For $1, for 1:200, you will be able to control $200. Now, if this is the case, it means that if you have $1, you will be able to control $100, which means 1%. So the margin for this leverage is, margin required is 1%. So 1:100 is equal to 1% margin required. Does that make sense? Which means, let's take it a step further. 1:50 is what percent? If you say 2%, you are correct. So that's 2% margin, which means 1:200 Can you guess? So if you said 0.5% margin, you are absolutely correct. So I want to assume that we understand leverage and margin. So when you are creating that account and they say your leverage, choose your leverage, this is what you are choosing. Now, let me explain how leverage works and how leverage may be to your advantage and maybe not so much to your advantage. Now, we discussed lot size. So before we go deeper, let's talk about lot size for a second. There are three types of lot sizes. I mentioned this earlier in an earlier course. You have the micro lots, you have the mini lots, and you have the standard lot. Now for the micro lot, you have it starts from 0.01 and it ends at 0.09. Now the micro lot, when you trade 0.01, what it simply means is approximately 10 cents per pip. So remember what a pip is. So approximately 10 cents, the average value per pip, especially for Euro USD and GBP USD, is 10 cents per pip, which means 0.02, 20 cents per pip, 0.03, 30 cents. And when you are doing 0.01, what you're asking the broker to do is 1,000 units of foreign exchange. 1,000 units. So 0.01 represents $1,000 or 1,000 euro, but 1,000 units of foreign exchange. You get that? So 0.02, 20 cents per pip, average lots, average value per pip, and then 2,000 units of foreign exchange. 0.04 in the same vein, 40 cents per pip, and which means 0.09, 90 cents per pip, and 9,000. So let's impute that. So this is averagely 90 cents per pip, and it represents 9,000 units of foreign exchange. And in this case, we are going to be doing $9,000. Now, for the mini lot starts from 0.1 and ends at 0.9. Just like the micro lot, the mini lot represents 10,000 units of foreign exchange, but the average value per pip is $1. And this 0.1 represents 10,000 units of foreign exchange. So 10,000 units of foreign exchange, which means $0.22 per pip averagely, and $20,000 or $10,000, 10,000 units of foreign exchange. It could be dollar, it could be euro, it could be about 10,000 units of foreign exchange. Okay. Now $0.33 per pip average value, and then 30,000. $0.88 per pip average value, 80,000. 0.9, which is $9 per pip value, and represents 90,000 units of foreign exchange. Now for a standard lot that is 1.0, this represents averagely $10 per pip, and this represents also 100,000 units of foreign exchange, and this goes on like 2.0, 3.0 in the same order. So 2.0 approximately 20,000, $20 per pip, and represents 20 200,000 units of foreign exchange. So we are going to use USD as the base. In this order, 3.0, $30 per pip average pip value, which means if price goes 100 pips, or let's say you are using a micro lot, if price goes 100 pips, what you have made is $10. If you are using 0.1 approximately, depending on the pip value. So in another course, I'm going to talk about pip value of the different currency pairs. Okay, now you have 0.1, if price goes 100 pips in your direction or against you, you are looking to either gain or lose $100 in that order, which means if you're using a standard lot and price goes 100 pips in your favor, that means $1,000 plus or minus. So having explained this, let's now go deep into understanding this, and before we talk about what volume you should use for your trading strategy. What volume should you use for your trading strategy? Okay, now look at a scenario. Let's go to the charts and let's say let's get GBP USD. So let's get a GBP pounds USD pair. Let's see this price 1.29818. So let's use this as an example. So let's say there is an account and this account has $200 in balance. I'm just using this as an example. So account balance is $200 and the account leverage, let's say 1:50, and then you are trading with 0.2. Remember, this is too many lots. This is just an example. Now, let us put this in perspective and for you to understand leverage and margin properly. Now, you have $200 in your account and you want to execute a trade 0.2. So let's say at the price that we just saw. So let's go back and reconfirm the price and use that price for this purpose. So let's go to GBP USD. Let's use 1.29822. So let's do 1.29822. So in brackets, let's just show this is GBP USD. Good. Now, what this translates to, literally speaking, is you are entering a position. This position is worth, remember that we said 0.1 is 10,000 units of foreign exchange. So 0.2 in this represents 20,000. Okay. Now 20,000 you are trading at this price, which is multiplied. So let's look at multiplied by 1.29822. Remember, when you are going to exchange any currency, you want to buy or sell, they ask you what is the quantity you want. So the quantity, when you trade with 0.2, the quantity you want is 20,000 units of the currency you are exchanging. Now multiply this by the exchange rate at the time you want to exchange it, which gives us approximately or exactly that's times 20,000. So we have here, so that's 1.29822 times 20,000. This should give us 25,964.4. So let's call this USD. Okay, now 25,964.4. Now remember that this account is using a leverage of 1 to 50. Now what did we say? If 1 to 50, that is 2% margin. Now this is what it means. Now this is where leverage comes to play. You need to, for you to be able to execute, remember your account balance or the account balance in question here is $200, and the total volume you are trading is 25,000 pounds, okay, or dollars, because if your account is in a dollar account, this is a dollar. Okay, now look at this. You want to do 2% of this price, 2% of this value, okay, 2% of 25,964.4. The 2% is 500, and so if you multiply this by 0.02, it gives us 519,288. $519,288. Okay. Now, what it simply means is that you don't have enough money to perform this transaction because of your volume and because of your leverage. Now, let's say that your leverage is not 150, that your leverage is 1:200. Now, what you need to do now is, remember, 1:200 is 0.5% margin. So what is 0.5% of 25,000? 964.4. So multiply this by 0.005. You will see that the number changes. Now, because your leverage is higher, so notice with a higher leverage, we are able to transact because your new value is 129.822. Now, see the power of leverage and margin. Now, for a $200 account, you are unable to place a trade with 0.2 when you have a leverage of 1:50. But on the same account size, if you increase your leverage, which means you can control more with less, you are able to trade 0.2 on a $200 account with a 1:200 leverage, because this is what you will have, and your free margin will be what is left after 129. So with one leverage value on the same account, you are unable to, so the broker will just say not enough money. Now, how does this translate to risk? Now, if you remember what we said about the mini lot, 0.2 is, remember, 0.1 is an average of $1 per pip. So if price goes 100 pips in your favor, if you're doing 0.1, it's $100. Now, if you're doing 0.2, that is $2 per pip average value. So if price goes 100 pips in your favor, you have $200, and if it goes 200 pips in against you, you have negative $200. So which means on a 0.2 account, on a $200 account, and you're trading 0.2 on a leverage of 1:200, price needs to just go approximately 100 pips to make you lose your entire account. I am using $200 to give this example because I want this example to sink in. I want this example to be, if I do $1,000, it may not make sense except I use bigger volumes, but a lot of retail traders can relate to this. Now, in the next course, I'm going to be giving you some suggestions on risk management. But before I do that, I'm going to explain to you the reason why I am having these suggestions. Okay, now it is important that I mention that, remember, 0.01 is one standard lot. I mean, 0.01 is 1,000 units of foreign exchange, and 0.09 is 9,000 units of foreign exchange. So if you are trading a $1,000 account, I recommend that your maximum volume should be 0.01. See you in the next course where I will explain my reasons, and we will take it a notch further, and you will understand who you are trading against, who is the counterparty, and so on and so forth. All right. Click the link at the description of this video, join our Telegram channel, and make sure you're getting updated on the activities of Copyvest Academy. See you on the other side. Bye for now.